Hello, and I have a presentation for you guys today. And today we're going to be covering intermarket analysis. Specifically, we're going to cover the intermarket relationship between equities and bonds slash interest rate market. This is actually something I promised to cover. It was a topic I promised to cover on the live stream from, I think, around 2 days ago. And I'm only just able to get down into this because I was working on of a project. But we're going to go into the relationship between bond market and interest rate market and equities. That is the focus of this presentation. Now, I have actually done an overview of intermarket analysis. I've covered the relationship between bonds, interest rates, currencies, commodities, and equities. But that is a video I've already recorded. You can find that on the course. I believe that is module 2 of the course. That's already done there. But I just wanted to go and do a little bit more insight into the relationship between bonds and interest rate market and also the equities market. Now, I personally don't trade equities market. I strictly trade currencies. Specifically, I trade major currencies or the majors. We're talking about US CAD, USD sometimes, Aussie, Euro, British pound. Now, once or twice, I might dabble into gold. That's once or twice, but that is usually very rarely, and I almost never trade crosses anymore. But we are going to cover equities, and this is specifically due to you guys' request for me to do something like this. So let us discuss the relationship between the interest rate market and equities. Now, when it comes to the interest rate market and equities, we have to understand that they are both positively correlated. So that means if generally I'm not seeing it is 100% correlation, meaning the correlation is mirrored. What I'm more seeing is if the interest rate market or the bond market. So we're going to talk about the bond market. I don't want to confuse you guys. Interest rate market is the inverse of bonds. Okay, so bond prices are inverted against interest rates. Now, I might use those terms interchangeably, and if I use those terms interchangeably, now I'm not going to do that on this video, but on live streams, I might use those terms. I might call treasuries market, interest rate market, because you're essentially the same thing, you're just inverse, right? But I want to be very specific so there's no confusion in your learning process today. So I'm going to use strictly the bond market. The relationship between the treasuries, which is bonds, and equities is that they are positively correlated. So if bonds are generally moving higher, then equities will also generally move higher. Now, I want you to apply, correlation between dollar currencies or bonds and also currencies. If the bond market are stuck in a consolidation, a lot of times it might not necessarily allow for one-sided displacement on equities market because we have investments or we have liquidity tied up in one asset class, which is going to be bonds. And I could show you examples. I could use a data time frame, show you examples where treasuries market was stuck in a range and that did not allow for strongly trending or hugely trending asset or markets in the equities market. So let's just go and look at price itself. This is not a topic that really is complex. It is just a straightforward topic. But I'm going to use a price action example of the Dow, which is what you can see here. So I'm using a futures contract for the Dow, and we're going to use that to define our example. So what I'm going to do here is I'm going to compare the chart of the Dow against that of the 30-year treasuries. And we're going to look at the comparison in real time. So I actually wanted to compare, and nothing's coming up. So I think I need to refresh. My screen. Okay, so let me try the comparison tool, and it should come up. Okay, so we're good. Now you can see the correlation. It gets out there positively correlated. The ZB1 stands for 30-year treasuries. Okay, so you can see that as we start to slide lower on the 30-year treasuries, now it does take time for the Dow to catch up with treasuries market, but it eventually bows into the treasuries market. And that brings me into my next point, and this is also a key point here. The bonds act as a leading indicator for equities direction. So the bonds are usually going to lead the direction for the equities asset or the equities asset class, right? Now, the correlation between the bonds market and the equities market, again, is not tick for tack, meaning it's not exactly the same. There is going to be lag times. Okay, so you're going to be times where bond market or bond prices are going lower, and you see essentially the equities market go higher. Usually, that's what I call a decoupled market or a disparity, right? And usually, when I see assets like that, usually there is a manipulation on the way, and I view it as such, and I don't necessarily go in being confused about what price is doing. So, what I want to draw attention to is this period in time, just from what you can see in our comparison tool here. This period in time between 10th of July, where we make a low on the bond market, or sorry, make a low on the equities market, which is the Dow. Then we also made a low on the 30-year bond market. You can see it starts to rally, and then after that, the treasuries market slides off. Okay, going into 19th of July, it makes a short-term high and starts to slide off into current market price action. Now that does not go for the Dow. The Dow actually continues to rally through the bearishness of the bond market, and it only starts to slide, making a short-term high around 1st of August. So the Dow makes its high 1st of August, while bond market already made its high around 19th of July. So you can see we have a disparity of around 13 days. So we have a 13-day disparity between the bond market and essentially the equities market. Now, I want you to look closely into this because it is essentially understand the relationship between these two asset classes. The reason why I'm selecting the Dow is because the Dow is more like a reference for the equities asset, and then I'm using the 30-year treasuries, because generally what the 30-year treasuries is doing is what both the 10-year and the 5-year treasuries would do, right? Again, they are similar, the 30-year treasuries, 10-year treasuries, 5-year treasuries, they are similar asset classes. Only difference is one measures long-term outlook for the treasuries market, the other measures an intermediate term outlook for the treasuries market, which is 10-year treasuries, and then the 5-year treasuries obviously measures the short-term outlook for the treasuries market. So they're essentially the same. So if I'm using 30-year treasuries, it goes for both 10-year and also 5-year treasuries market. All right, so now what you can see here is you can see we had the 30-year treasuries rallying higher, right? You can see the rally higher. And also at the same time, that allowed for huge displacement on the upside on the equities market. Okay, so when I say equities market, I mean the Dow. Huge displacement on the upside. Now, we make a short-term high on the treasuries market and then start to slide off. Now, you think, well, but Gene said they're both correlated, meaning if treasuries are going to slide off, then equities are going to slide off. Well, why was equities not sliding off? Now, the reason why this point really is important, this is a very key point here. When you're dealing with correlation, when you're dealing with market relationship, you need to understand if you're dealing with relationship between two different asset classes, even if they're the same asset classes, they are not going to move exactly in tandem. A lot of times you can get lag time, and the lag time between the correlation of two correlated asset classes, that is key information. That is information that there's manipulation on the way, or there's a trend reversal on the way. And while everyone else is chasing the move, you already have insights into what price is supposed to do next, which is what I'm about to show you right now. Now, what you can see is while we have that short-term retracement on the 30-year Treasuries market, we had huge upside, clearing out buys liquidity on the equities market. Now, while we're sliding off, you think, well, we were bullish on the equities market. But no, we're not bullish. We made a small range. You can see this range here as the treasury market starts to slide off. It's not the same. This displacement higher as the equities market starts to slide off is not the same as this one. This one is more parabolic. You can see how the market creates inefficiency, goes higher, it barely creates a new down candle, creates another inefficiency, and that's what will make that short-term high on the treasuries market and starts to slide off. It does not allow for exponential upside on the equities market, and that's the relationship I was talking about, right? Usually I call this the coupled markets, which is where that usually gives me insight into what I anticipate in terms of price doing. But what you can see here is if the bond market or bond prices are declining, if you're having lower bond prices, that would not allow for higher equity prices. Now, that does not mean you cannot get short-term bullishness in the equities market. You can definitely get short-term bullishness in the equities market, but if you wanted to look for exponential bullish rates, right, you want to do so when bond prices are actually in sync. And again, I'm strictly talking about higher time frame. This is for like longer term outlook, daily sentiment, and all those things. You can also apply this on lower time frame sentiment, which is I think that will be the final example I'll show you guys. But again, you can see what I'm talking about, where as you're building that daily narrative, because one of the things I teach students, and I'm saying students because this might go on YouTube, is that when you're building a narrative on the daily time frame, you need every support of your narrative you can get. And when I mean you need every support, I mean you need to confirm across different asset classes. The narrative on one asset class should be confirmed across multiple asset classes, and this is what we call intermarket analysis. Right. So intermarket analysis is a revolving of four key main asset classes. So we have currencies, we have commodities, and for commodities, look at gold and silver. We have equities, which I'm talking about, and then we have, I believe, treasuries or bond market or interest rate market, right? So these are the asset classes we use. A lot of times I don't use the equities market because the bond market is enough for me. Sometimes I might go into commodities and look at gold or silver, but that's enough for me to confirm a narrative, and that's why my daily sentiment is extremely highly probable. So when I give you a daily bias and tell you this is what I think the market should do, which is what I do on a day-to-day basis, you can see how precise and how often, almost on a day-to-day basis, it delivers. Because usually my narrative has a confluence of a different asset class. All right. So now what you can see here with that relationship between the treasuries market and also the equities market, you can see that when we make a short-term high, or as we start to rally higher, and bond prices start to rally lower, or not rally, but decline lower, you have a leading indicator for lower prices on the equities market. Now, what do you pair that up against? Why did this happen? Why were we running higher on the Dow? The reason for this, the reason why we went exponential and we still went slightly higher, is because we're going for buy side liquidity. Look at this week here. Buy side liquidity, all of this inefficiency, and this old high here. Price was going for the liquidity. Now, if I'm watching this, I'm looking at this as a manipulation, right? Because if the treasuries market is making a lower low, it's not going to allow for a sustained rally on the equities market. So that's a key insight into lower prices on the equities market. Right? Can I identify a very clear jump liquidity on the equities market? Yes, I can. We have very clean lows down here. We have very clean lows down here. So if I start to see a shift in structure, then I know where my next jump liquidity is. and I can trade in sync between this high and this low, understanding I am focused on the bearish side of price. Now, obviously, there's going to be retracements and everything, which is perfectly fine, but I will focus my sentiment or the bulk of my trades on sells. So that means if I'm nailing short, I'm looking for short-term to swing trades. If I'm trading longs, I'm trading day trades or scalps, bullish retracement into premium before the market starts to sell off. So this is how you utilize a relationship between the equities market and the treasuries market. That's the relationship. All right, now what I like to do, which I'll show you this on a lower time frame, is I like to confirm if I am bearish on again, I don't trade the equities market, I trade currencies, but let's assume I trade the equities market. If I'm bearish on the equities market, okay, what I will do is if I anticipate a short-term high and I'm unsure of that short-term high, or not necessarily unsure, but I'm looking to qualify, okay, so I think that was the wrong word. If I identify a short-term high and I'm looking to qualify that short-term high, right, I like to qualify swing points with SMT. You don't necessarily need to qualify SMT between the equities assets or equities market. So when I say between the equities market, I mean like for SMT between the Dow or ES Mini or freaking Nasdaq, right? So some of you guys should go in, and if you wanted to short this daily eye here, you're gonna look for SMT divergence between Nasdaq and also S&P, and say, oh well, let me see if I can spot a divergence here, and then that will qualify this as a swing point for a run on the sell side. You don't necessarily need divergence on the equities market. You can use a different asset class, which is the treasuries market. So now let's go and look at this short-term high. Prior to all of this decline here, could we spot a divergence on daily time frame prior to all of this decline here in the treasuries market? Now, I've not looked at this. I'm assuming there's going to be some flashing divergence there, since we can obviously see the subsequent lower delivering price. Let's see if I could pull up. Ten-year treasures is not popping up for some reason. Let's see if we can pull up 10-year treasures. Well, we have a problem in which our 10-year treasures is not pulling up. Okay, it is not pulling up at all. Let's see if I can get this to come up. If it doesn't, then I probably might have to open a new tab or something. This is not coming up. I wanted to show the divergence on the daily time frame for this high here. Okay, so we have that high between let's get rid of the 10-year treasures. So if you look at this high here, before we retrace up into this and sell off, you can see on the orange line is the 30-year treasuries, and the yellow line is the 10-year treasuries. Okay, so we have a 30-year treasuries, which is the orange line, and then 10-year treasuries, which is the yellow line. So let's see if we can, at this short term out here, if we can spot where there was a flashing divergence between both of them. So between this side and also between this side here, we can spot a flashing divergence between both of them. So at this side here, we'll make a sharp rally, taking a short term high. We have a little bit of a retracement that does not break structure, and then we go up into this side here. Okay, so as we go up into this side here, prior to us making a daily swing high on the equities market, we actually made a high. You can see this line here, a very sharp rally and decline. That's a swing high there on the 30-year treasuries. So we have two swing highs here on the 30-year treasuries. As the equities market, which is in this example, the Dow, as this is rallying, okay, retracing up into a premium. We also had the treasuries market also retracing, but in the process, they flashed a divergence. You can remember they will lead the equities market. That was a statement I made at the start of the video. So go back and rewatch the start of the video, and you hear me talk about how the treasuries market will lead the equities market. You can see here we have 30-year treasuries go higher, but we don't have the 5-year treasuries go higher. It actually goes lower. So it makes a short-term high, higher short-term high, and the 5-year makes a short-term high, and then the lower short-term high. So without even looking at the other equities asset, you can already see we have a divergence in price. Now, it's not just enough to go in every single time looking for a divergence. Obviously, you need to have a journal liquidity and a confirmation of narrative. So a confirmation of narrative essentially is if your journal liquidity is bearish, then you're looking for premium arrays to be respected, and you want to see the market displaced from premium arrays. If you identify premium arrays and your journal liquidity is on the sell side, and you see your premium being disrespected, then most likely your narrative or your journal liquidity is wrong, because the narrative does not match your liquidity draw. And that's why I've taught my students and also traders that it's not enough to have a journal liquidity. That journal liquidity needs to be actively and also constantly being confirmed by price. No indicator, no concept, no ICT concept, no nothing beats real-time price itself. That is the biggest lesson I've learned in my 5 years of or 6 years of trading. Nothing beats real-time price. All the information you need about price is what you can see in real time. So if you have a journal liquidity and it's not being confirmed in terms of narrative, right, then most likely you're wrong, and you have to revisit where you got it wrong. And this is where a lot of people struggle in terms of accepting losses, and then they go into a tilt, right? Because they have a sentiment, they probably have an higher time sentiment or lower time frame sentiment. A lot of times, you guys will say, "Oh, I can identify equalizer, I can identify equal lows, and that means the market must trade down into equalizer, equal lows." Well, if the market's not doing so, why are you still forcing the trade? And that's one of the things that has helped me in terms of managing risk and also managing expectations. If I have an expectation of a delivery and that is not being offered to me, I don't go in and force the delivery. If I cannot make the case for the other side of why I was wrong, I just simply step aside and do nothing. If I can see very clearly where I got it wrong, and due to current market price action literally proving me wrong, I'll go in and take the opposing side of my initial sentiment, and oftentimes I end up with profits. But a lot of times, if I don't, or if I cannot identify clearly, where I got it wrong, because again, at the time you're trading, there's all sorts of emotions running, I usually just step aside, and it prevents me from so many losses. A prime example, and again, this is to the guys on Discord, a prime example would be on Tuesday. You can see on Tuesday, I was totally upside of price, all right? I got my sentiment totally wrong. I think I was the only one that day that had my sentiment wrong. And what did I do, or what did we do on Discord? We did not even take a full stop loss. I took a 0.4% loss, right? Risking 1%, took a partial loss, and stopped trading for the entire day. And you saw the next day we came back and I literally outdid. Just wiped the floor with the loss from Tuesday. And that was because I understood I was on the wrong side of the marketplace. The market was not confirming my narrative, and I stepped aside. And that's one of the biggest things you can learn about price, is understanding that nothing will ever beat what you are seeing in front of you at that moment of setting expectations or while you're on an execution. Okay, if you're not taking any, you know, information from all the things I've been saying so far, this is very, very key in terms of your understanding of price. Now let's go and look at the lower time frame. Now the same thing I've talked about in the higher time frame, you can also apply this on lower time frame. So you can see here on Thursday, so we are in a Saturday. So this is this week's price action. All right. So on Thursday, what you can see on the first of all, let me do a breakdown of ES, like a S&P. So on Thursday, what you can see in prices, we started off the week with a rally on Monday, rally on Tuesday, and we're rallying up into a premium. Now, why would you trust this to be a premium? Because in the process of rallying up into that premium, we have cleared out buys of liquidity. We have cleared out this buys of liquidity here, right? And then we traded up into a fair value gap with a breaker block. Where is the breaker block? The low of this candle, this huge beefy candle that runs this eye and also this eye. That's my breaker block. So we return up. Now I don't want to draw the lines for the inefficiency. It's not really that necessary. Okay, you can go in and put lines for the consequent encroachment of this inefficiency, but again, it's not really that necessary for the lessons I want to teach in this video. But you can see we run up into a daily premium on Thursday. And as we run up into daily premium, now, what was the interest rate market or treasuries market? Not interest rate market. Interest rate is the inverse of treasuries. What was the treasuries market doing leading up into this decline on Thursday? Now, what economic release did we have on Thursday that led to the decline on the equities market? You can see we had core CPI numbers at 8:30. So if we go and look at the equities market at 8:30, okay, this is 8:30 here. So we rallied up on Thursday into that daily premium, which is that daily breaker block, and in the process we ran a short-term high, which is the initial high of the week from Tuesday. Now if you remember, one of the most powerful liquidity pools are weekly highs and lows and previous week's highs and lows. Okay, they are very powerful liquidity objectives or points in which there will be a lot of interest from the retail in participating in transactions. So we ran above the initial high of the week from Tuesday, and as we run above that, we created a range and we saw displacement that creates a fair value gap, which we returned back up into late into New York session, and then we saw this massive rally or decline, not rally, my bad. We saw this massive decline on Thursday and eventually ended up trading down into the opening gap for the week. All right, that's what we traded down into on Friday. But again, this is not the topic of conversation for today. I'm more interested in the relationship between or the clue as to why this dropped on Thursday. Now, if I go and pull up a chart of the 30-year Treasury on a 1 hour time frame and similar for, I'm not sure if the 10-year Treasury is going to, okay, it's working out. Just literally stressed me. And then the 5-year Treasury. So now, prior to the decline on the equities market, what you can see on the Treasuries market, Treasuries market, I think that was correct. So what you can see on the Treasuries market prior to the decline is I want you to watch as we rally up into that daily premium. As we rally up into the daily premium, you can see that the orange line is the 30-year Treasuries, the blue line is the 10-year Treasuries, the yellow line is the 5-year Treasuries. You can see as we are rallying up on the Dow into that daily premium, we see that rally subsequently on the 30-year Treasuries market. All right, we see the failure swing. This makes a lower high, right? So while 30-year Treasuries was rallying, 10-year Treasuries was making a failure swing. 5-year Treasury was also making a failure swing. So we have a failure swing on the 30-year treasuries, on the 10-year treasuries, and also the 5-year treasuries, while this ran into a deeper premium. So we had a flashing divergence there, and then we started to see decline, starts to sell off. And you can see as it starts to sell off, it confirms the program of the equities market. Now, is there a clear on liquidity that price can reach for? Yes. We have these clean lows down here. That's the lows from Tuesday. What's present underneath the lows? Inefficiency. Now, what have I taught you about liquidity? If we have a liquidity pool in close proximity to an inefficiency, the market a lot of times will not only trade down into the liquidity pool, it will also reach for the inefficiency. All right, so if you are looking to sell short, your objective would be this inefficiency here. All right, so let's go into, and obviously you can see on a 1 hour time frame, we trade up into this 1 hour fair value gap, and then that's where we had the massive sell off on S&P and Thursday. So let's go on the lower time frame and see more precise deliver profile on the lower time frame. You can see we had this 15-minute rejection block. Okay, this is a bearish rejection block. We ran above here, and all of this is all trapped liquidity, meaning anyone who's buying on the stop above the short to my, they are now trapped. As soon as we displace lower, okay, above the short to my, price returns back up into that 1 hour fair value gap and trades up exactly into the rejection block, exactly up there, and then tanks. Now, what was the clue on the 15-minute time frame? Again, I just showed you on the 1 hour time frame. Now let's go on the 15-minute time frame. We're not even looking at divergence on the equities market. You can go in and look for divergence on the equities market, and that will still be valid. But what I'm teaching you, because you can apply this to all asset classes, I'm teaching you that you can also utilize bonds market or treasuries market for your choice of trades. This, you could have used the equities market to facilitate this trade. And I want you to go to your assignment, go and watch this time window, and you would see the equities market was leading the drop. Okay, but outside that, let's go on and look at this on the 15-minute time frame, and you would see literally the same thing there. And I think this is a lot of noise, so I'm just going to, let's do a comparison between the 30-year treasuries and the 10-year treasuries. You can see the 30-year treasuries was making a lower high, and the 10-year treasuries was making higher high in price. So you have your divergence just before CPI numbers, and then it tanks, it leads, and then the equities follow suit. So that's your lesson for today. So your job is to go in and study the correlation between the equities market and the treasuries market using what I just taught you for today. So I think this has been quite long. It is around 33 minutes, over half an hour. So I do apologize about the length of the video, and unfortunately, just nothing I could have done about this. I'll catch you in the next video, and trade safe.